Welcome to Innova's first recorded podcast. Its aim is to give you the ability to listen to the commentary when you have the time available, and we'll have a follow-up question and answer session where you can ask questions in person or send them through prior to that session. Depending on the questions and answers, we may compile a follow-up communication as well for you to reference. Our aim is to make these quarterly, but that will depend on their success and feedback from you as our clients. And one point of note, because these are recorded, we won't be talking about any managers specifically, but questions regarding managers or strategies can be asked in the Q&A session if you so wish. Please note that nothing in this presentation is given as personal advice. It's been designed for viewing by professional investors only, and anyone wanting to make any investment decisions should do so under the guidance of a licensed advisor. So what we will go through is recent market activity, given that since the start of the year we've had a bit of a Dr. Jekyll and Mr. Hyde type market. We'll step back and have a look at the current economic status domestically and globally, as well as an outlook for traditional and non-traditional investment markets. And I've got a bit of a thought experiment that I wanted to go through with you on long-term investing and I guess conviction in your positions and in your investments. So recent market activity, this is a busy slide that I'll explain in a second. If you think back to the start of January, the US Congress had just passed tax cuts leading to market rallies, in particular in the US in January, as the market factored in higher corporate earnings, which interestingly had already been factored in anyway after Donald Trump got elected, but that's aside. But then February came along and US wage growth data came in reasonably strong, and we have had for the last number of years everybody looking everywhere for signs of inflation coming through, and this spooked inflationary fears. And inflation fears, when you have an expensive equity market and an even more expensive bond market, are a lethal combination. So at the start of February, this was the spark that led to the VIX complex meltdown. So that's what I'm kind of outlining here on this very busy slide. On the far left, I've got a cutout of one of the pages from the white paper that I wrote just prior to the VIX meltdown, and at the very bottom with the two red circles I've actually outlined what could happen if the VIX jumped from 10 to say 20, how there would not be enough volume for the two largest exchange traded products to actually be able to rebalance at the end of the day, and in the aftermarket they wouldn't be able to trade at the spot. They would have to trade at a much higher level. I've got a green arrow pointing to what actually happened in the aftermarket with the grey line because it was during our market hours, so we could see it happen. And you can see that that's exactly what did happen. The VIX traded as high in the aftermarket as 50, which caused the absolute collapse and implosion of those two ETPs. We saw the VIX jump. We saw equity markets fall at the start of February quite violently, as much as 10% in the US. They bounced back towards the end of the month, and then the incoming Fed Chair Jerome J. Powell gave his speech where he used something foreign to investment markets, and that was plain English, where he explained that wage growth, yes, it was relatively strong, and the market treated his plain English rhetoric the way they've had to treat the previous Fed chairs, very cloak and dagger esque approach to communicating with the market as having underlying meaning. They assumed that meant that the 3 rate hikes that the Fed had announced to the market actually meant that this may mean that they were going to raise 4, 5, 6, 7 times, that it wasn't actually 3. This caused the market to start falling in February, towards the end of February, and it wasn't helped that during the week of NAFTA negotiations, Donald Trump came out and said that he would slap 25% tariff on steel imports and 10% tariff on aluminium imports. That caused the market to fall further, and Jay Powell had to come out and, with a subsequent speech, obviously not verbatim, but saying to the market that, hey, look, wages growth is strong, but wages growth can stay strong for quite a while before it'll feed through to core CPI. And even if it does, that doesn't mean it's going to affect the path of rate rises that the Fed has currently planned. So please, everybody, just calm down. I'm just telling you, what is actually going on and trying to be quite frank and upfront about our approach. So given all that noise that's gone on in January and February, if we take a bit of a step back and have a look at what is going on in the world from an economic standpoint, thankfully, we don't see any immediate signs of recession anywhere around the world. Global leading economic indicators are all still positive. On the chart, on the slide, we've shown a series of yield curves. Yield curves are a fairly commonly used leading economic indicator, and an inverted yield curve, i.e. when they turn negative, is a fairly a good indicator of a future recession. In fact, I don't believe there's been a circumstance where there was an inverted yield curve in the US that didn't precede a recession. And an inverted yield curve would be one of these blue lines going below zero. The most interesting one, though, is the largest one we've got on the right-hand side there, which is the 30-year minus the 5-year, or what is referred to in the market as the 5s 30s curve. Obviously, that has been dropping quite a lot and is down around the 0.5 mark, which means it is an extremely flat long end of the curve. That doesn't bode particularly well for long-term expected growth prospects in the US. However, in the short term, economic growth does still look good in the US and, in fact, everywhere around the world. One thing to keep in mind, though, is that economic conditions usually look their best at the top. So the few leading indicators out there that are reasonably consistent or reliable, such as yield curves, are worth keeping an eye on, as conditions are excellent at the moment. But conditions don't turn south before a recession. They generally turn south, during the recession. What we find interesting is that the US is passing tax cuts and stimulus packages at a time of low unemployment, strong PMI growth, and the beginning of wage inflation, which seems like strange timing. 2009, 10 and 11 really were the years for stimulus, not now. We're not sure now is a particularly clever time to be doing that when the Fed is trying to cool the economy somewhat. Now, I just mentioned that the world is growing relatively strongly. We see in Europe reasonably strong GDP growth. Inflation remains benign. The ECB has announced that by the end of this year they will have tapered their bond purchasing program, but they will continue with their accommodative stance. And so if we do see any kind of bumps along the road or any hiccups, don't be surprised if they extend that bond purchasing program, and they're likely to leave interest rates low for some time. And the world truly is in a period of synchronized growth. All countries that are monitored by the OECD are all expanding, and I think 33 of the 43 nations that are covered are accelerating that expansion. Now, this growth phase started off slowly. If we think back to the GFC, those countries that actually underwent a recession, the rebound out of that recession was the slowest on record in many places, such as the US. But the rebound, whilst it started out slow, and was one of the most anemic on record, has now been running for 9 years. So whilst it was slow, it has been very long. So that's worth taking stock of. If we then turn domestically, unfortunately, we're not seeing the same sort of participation in the global growth. I mean, Australia is still growing, but not at the same sort of rates as we're seeing around the rest of the world. We're not seeing wage inflation the way it's being seen in the US and Europe. Australia's inflation has remained low. In some ways, this is a good thing because the RBA isn't being forced to raise rates at a time when the Australian household sector is just disgracefully over indebted. On the slide here on the far right-hand side, we've got here the Australian household debt ratio is now above 180%. We're one of the most indebted households in the world, if not the most indebted household in the world. So any interest rate rises will cause mortgage stress on certain pockets of the Australian economy. To be frank though, for a properly functioning economy, we actually need some stress to wash the economy clean of poor lending standards, excess credit and speculative activity that's actually value destructive long term. So whilst our yield curve remains positively sloping, which is that blue chart in the middle of the slides there, if there was an increase in interest rates, that would probably lead, by the RBA, that would probably lead to mortgage stress that could lead to a nosedive in our economy. Strangely though, it's been overseas inflation expectations that have driven the performance in domestic interest rate sensitive securities over the last 3 months, which is why I've got the performance of those securities down at the bottom of this slide. In reality, domestic inflation can decouple from global inflation and should be the main driver of domestic security performance of those interest rate sensitive securities, but it has been the whipsawing of expectations overseas that has driven returns domestically. So whilst our economy has, whilst I sound fairly negative on the domestic economy, that's not necessarily the case. What could save our economy, and the reason why we actually have a fairly neutral outlook on Australia in general, is that it would be a really strange environment indeed if the world was growing, especially if everywhere in the world was growing, and commodity prices were collapsing. It remains a fact that Australia is a commodity exporting nation, and strengthening commodity prices firm up our terms of trade, improve our trade surplus from our trade status from deficit to surplus. So we'll talk a little bit more about commodities later, but if the world continues to grow unabated, we should be a beneficiary of that, given our resource export or the resource export nature of our economy. So that's a little bit about where we've been and where we are. What's more important is where we're going and what the outlook looks like. So whilst economies look strong, we don't invest in economies, we invest in markets. And most of that economic strength is fully priced into most markets. Whilst we still forecast positive return in most traditional investment securities, it's fairly low compared to history, and there's higher than normal uncertainty attached to those positive returns. And in fact, there are some asset classes that we don't forecast a positive return. In fact, we forecast a long-term negative return for things such as Japanese government bonds, German bonds, other European sovereign bonds, in particular high-yield bonds in Europe, potentially high-yield bonds in the US. US equities in general are unlikely to provide, it's very low probability that they'll provide a good positive real return over the next 10 years, which is why those areas are in bright red in expensive territory on that table there. So it's in times like this that we don't believe it makes sense to take unnecessary risks, and you probably want to diversify more than usual and wait for opportunities as they present themselves. Speaking of risk, if you think back to the earlier slide where I was looking at Australian securities being whipsawed around by global inflation expectations, interest rate sensitivity is commonly measured by the duration of an asset class, and usually market investors only associate duration with fixed rate bonds, but actually other instruments have duration as well. So you would have heard the phrase bond-like equities and how they've been the beneficiaries of accommodative central bank policy and falling interest rates. Well, the obvious candidates for that are REITs and infrastructure, and that's what the general rhetoric has been. Well, instead of taking that assumption and just taking the market's word that those instruments are in fact interest rate sensitive, we thought we'd test it. Interestingly, if you look at the chart on the bottom left, the red line is infrastructure, global infrastructure stocks. They don't have as much duration as the market may believe, even though they've been acting recently as if they do. They don't. But Australian REITs generally do. But we also do this analysis on Australian equity managers and the market in general, which is the larger chart on the right-hand side. I've only included 3 managers in here because the chart, we've got one of about 15 managers, but all the colours all start to blend into one and you can't differentiate between them. So I've chosen one with just 3 compared to the market. And you can see there that 2 of the managers have crept up to having essentially a beta of 1 to the to Australian Commonwealth Government securities benchmark, and so have a lot of duration in their portfolios. So why is that important? Well, if we're entering a rate tightening cycle, and we know that we have entered a rate tightening cycle in the US and in Canada, we are likely to enter a tightening cycle in Europe at some point. We don't know when that will be in Australia, but at some point we will have to. And we want to know what shocks to the system will mean to portfolios. So if there is an unexpected spike in inflation, what that could mean, we need to test for things and what those shocks mean to portfolios. So in the previous slide, we showed that the normal places to hide, generally sovereign bonds and cash, aren't likely to be great places to hide this time around. You're not going to lose money out of cash in a nominal sense, but if inflation comes in higher than expected, you could lose money in a nominal sense. Sovereign bonds are likely to sell off, but if we're there's not much point in reducing exposure to those areas if it shows up in other areas such as your equity managers. So I thought it was pertinent when talking about risk to really understand on a look-through basis, how that can be addressed and how that's looked at. Which brings us to the next slide. If traditional asset classes are relatively expensive, if the traditional defensive assets, in inverted commas, or places to hide, such as sovereign bonds that do well in equity market sell-offs, may not do well this time around. Unfortunately, we need to look at more alternative places of return. Ideally, we'd rely on traditional asset classes for those sources of return because they have longer histories, they're easier to explain, our modelling has a better fit for them, and their management costs are lower as well. But unfortunately, traditional asset classes aren't cheap, so we need to diversify more than normal at times like now. And what's worse, as I mentioned, safe assets in some circumstances are more expensive than the so-called growth assets. So we look for areas where we can understand why we should get paid an economic return for taking on risk, and then assess whether these areas look like reasonable investments or not. Are they backed by academic and empirical evidence? Are they liquid investments? Are there actually investment vehicles that can access them? So there are things such as risk factor premia, like the value premium in equities, or quality or momentum premium in equities, trend following across asset classes due to herding and other behavioural biases that humans display, insurance premiums such as carry available in currencies, or roll premium if it's positive, term premium, or the optionality premium or option premium available in options markets. All of these are actually reasonably easy to understand, have a lot of empirical evidence, and we can get access to, and there are reasonably long track records or reasonably long histories that we can test these against. The last one we've got there, commodities, is actually an area that we don't believe you should get rewarded long-term for owning. The reason being is that demand can always be met with supply, and there's no shortage of supply in the ground. However, a few of our models are showing that commodities are cheap in general, and if you have a look there at the 5, 7 and 10 year return of just broad-based commodity indices, they have not done well on a compound basis for a long period of time. So whilst we don't think you should get paid for owning them long term, given that they haven't done well for a long period of time, And there is a risk that we may enter an inflationary environment. I'm not saying that we will, but there's certainly a risk out there that we could enter an inflationary environment. There is also the risk out there that we could enter a period of questionable central bank intervention. During those periods, market participants want to own real things, and commodities fit that bill. So if you combine those two scenarios, one of higher inflation and one of questionable central bank intervention, with the fact that commodities have not done well over a long period of time and kind of look cheap compared to the marginal cost of production, they may be something that we own in the future. Figuring out how we own them and how we model them is going to be the problem. But don't be surprised if we do potentially own some commodities in client portfolios at some point in the future. Finally, I thought it'd be an interesting thought experiment to have a look at Berkshire Hathaway shares compared to the S&P 500, given Warren Buffett's infamy as a stock picker. And so I got the daily share price of Berkshire Hathaway back to 1980 compared it to the S&P 500. Needless to say, Warren Buffett has beaten the pants off the index, so much so that the chart on the left, you can't even see the orange line. Both of that's supposed to be a growth of $100 from 1980, and yet the growth of the Berkshire Class A shares is so extreme compared to the S&P 500 that you can't even see the S&P 500 line. And so I've had to put it on a log scale on the right so that you can actually see that they're a comparison next to each other. A lot of this outperformance came during periods where the market was falling or not doing a whole lot, because Warren Buffett is well known for his two main rules in investing. Rule number one, never lose money. Rule number two, never forget rule number one. So I thought it'd be interesting, and I pose the question to yourselves, just a thought experiment. How do you think Warren Buffett fared relative to the index when he actually underperformed? Because no one can outperform all the time, and given his outperformance is so extreme, what would his underperformance have looked like during the periods where the market's running hot? I mean, Warren Buffett is known for waiting patiently for attractive opportunities to present themselves when the market is running hot. He sets himself up for the long term by managing risk in the short term, regardless of what other market participants are doing. So what sort of underperformance do you think you would have seen from him? Like on an annual basis, 10% under the benchmark, as much as 20? Well, we'll have a look. On slide 11, it shows the relative underperformance of Berkshire Hathaway compared to the S&P 500. The big red line is when Berkshire is underperformed on an annual basis by 10% or more. Not only is Warren Buffett regularly underperformed by 10% and 20%, but he's had a period of underperformance of greater than 50%. Right, granted, that was during the tech bubble, but if we ignore that, even in the 90s and as recently as 2010 and 2011, Warren Buffett underperformed the S&P 500 by more than 30% on a rolling annual basis. Now, I don't think anyone would say that they wouldn't want Warren Buffett's track record, right? But if you didn't know that this investor was Warren Buffett, would you retain them as a manager, regularly underperforming by 15, 20, 25, 30% compared to the index? This shows that you kind of need to put up with some relative underperformance and that styles go in and out of favour. It's the ability to put up with periods of bad relative performance that compensate you for the long term. Managing risk in the short term, but invest for the long term so that you can let the powers of compounding work in your favour. Looking at performance relative to the market or peers would definitely have you missing out on Warren Buffett or even the next Warren Buffett. There's no way anybody that looks relative would have invested with a manager who can deviate this far from the benchmark. So look, the next time clients are asking about performance of a single line item in their portfolio, or they don't seem able to understand the concept of risk-adjusted returns, I would suggest showing them these charts and telling them the story, because they will know who Warren Buffett is. But I doubt very much they understand the magnitude of Warren Buffett's underperformance compared to the S&P 500 and the amount of compensation that can be gained by investing for the long term if you're able to ride out underperformance in the short term. So with that, I hope you found this podcast useful and look forward to your questions during the question and answer session to follow. Thank you very much.